Okay, great. Welcome, everyone. Thanks for joining, and thank you for having me, Marty. Talk about a full circle moment. I got my start with Maxwell Drever in real estate fundraising.
Oh my gosh.
And worked with this young woman, Sherry.
I think that's how I know you. Yeah,
yes.
Yep.
So that's how I got my start. My name's Margret. Hardardottir. I am now the Senior Vice President at Argosy Real Estate Partners. I joined recently just this summer to help them raise their sixth flagship fund. Argosy actually got started as a family office, and they are a experienced distressed investor that focuses on bringing an institutional approach to the lower middle market. And at this point, I'd love to have everyone just kind of do a brief introduction for themselves. Let's start with you, Chris.
Absolutely. So Christopher Hussain, I'm CEO and founder of RealKey. Background is in the mortgage space. I was actually the #1 mortgage originator in the US for 2 straight years. And to date, I'm still the only individual who's not only been licensed in all 50 states, originated, processed, and funded in all 50. Prior to going through and starting RealKey, I co-founded a company called Syndio. You might have heard of it locally. It was an online brokerage that is now part of Freedom Financial, raised about $50 million for that company. And prior to that, and being the top mortgage originator in the US, I was also owning a 100-person branch office of my own and national sales director for that franchise brokerage, which prior to the housing crisis was actually the largest franchise brokerage in the US for national mortgage services. Unique background, cross-functional technology, as well as unique subject matter expertise.
Excited to hear some of your thoughts on the market.
Absolutely.
And next.
Thank you all for having me, Margaret. My name is Julian Scurci with Lawson Capital Advisors. I've done my whole career for about 20 years in the alternative asset management space, predominantly in real estate private equity. I started at the REIT world, Prologis. I've pretty much touched every commercial real estate class besides raw land. I mostly deal with existing assets. I'm a GP in some fund strategies, as well as being outsourced capital advisory service for capital raising for various sub-institutional strategies. I've been spending the last few years mostly in the structured credit world, preferred equity, and on various strategies. So opportunistic, value add, and distressed, and very happy to be here.
Thank you. Rich, would you like to introduce yourself?
Yeah, Rich Gupta here. After leaving Wall Street, I guess, in 2007, 2008, we are part of a multifamily structure that we mostly focus on apartments, senior housing, and commercial class B, C buildings. We also lend as a hard money lender, and we are also building a hard money lending platform using blockchain and AI.
Okay. Thank you. Stephen?
Good afternoon. Thanks for having me. It's a pleasure to be here. My name is Stephen Shipp. I'm the CEO and CRO of Performance Advisory Group. We are focused exclusively on distressed commercial real estate, which is what I've done the vast majority of my life. I started my career as a very young vice president with a national bank, eventually running their workouts groups. I've also been the CEO of a special servicing operation, but most recently, over the last 15 years, I've run several multi-billion-dollar portfolios as CEO and CIO. Our primary role today is that of loan advisory work. We work with borrowers who are facing significant distress in their portfolios or single assets. We restructure their debt, come up with solutions that are sustainable. We work with banks, lenders of all types, really. But we're also investors. We're investing in stuff that I know and love deeply, which is distressed commercial real estate. And we're seeing certainly an uptick in that space today. So, yep, that's what we do. Thanks for having me again.
Thank you. I'd like to start off with a general question and outlook, especially given today's news with the rate cut. Christopher, would you start with your general outlook for real estate in 2025?
Yeah, I definitely think it's great that we finally have a rate cut. I think everybody's very excited for that. However, at the same time, I think that it still comes with a little bit of a mixed bag. Rates coming down is great, but housing is still very expensive, and those rates are still very high. And so, whereas I do know that those that may have bought a home in the last couple of years are going to be looking to refinance, many people are going to be looking to go through and to relocate and not be so locked into the ultra low rates that they had. You're still looking at the haves and have-nots has increased substantially. There's going to be people who just cannot afford to go through and to become new home buyers. So I don't think that we're going to be seeing new home buyers entering the market until we see the affordability be addressed. And really the only way to do that is going to be through regulatory. We're seeing some of it, as we talked about earlier, with going through and seeing some of the short-term rentals, your Airbnbs going through and being restricted. You're also going to go through and start seeing more regulation for overseas buyers. We also have a room full of family offices that own a substantial number of what we consider residential as 1 to 4 unit properties. And there's already talks, and it's definitely something that's on the Democrat side. Kamala Harris, she's already been very pointed about going through and putting some restrictions. In addition to going through and looking at, you're also looking at imposing additional taxes for particular thresholds for corporations. And let's also alternatively look at, there could be any major player that does own a large number of these properties. If one of them is to go through and to decide there's a better asset class, thanks maybe to the rates coming down, you don't want to be the last group going through and sell. That'd be the second, third, and that makes a snowball effect.
Yeah. Rich, I'd like to hear your outlook for real estate 2025.
I can tell you this, just respond back to Christopher's comment about the 50 basis points. We were kind of surprised that Fed went with 50, which was the least expected from guys like us, but the market was expecting it. You still have a strong economic growth, less than 5% unemployment, and equity markets at the all-time high. So it caused a surprise. As far as the 24 and 25 commercial markets are concerned, we still believe that there is still a lot of dislocation has to go through, mostly in Class A, Class B buildings in money center cities, where you have maybe 50, 55% occupancies. So that distress still has to come through. In addition to that, we also are looking for more and more dislocation in apartment buildings within the cities where there's tons of rent control activities going on. So those two areas, watch out.
Definitely, we could get into that maybe in a little bit. I'd like to hear from Julian.
I think the Fed candidly is a little bit of a sideshow. I think they're always late to the party. They were too late on inflation and they're too late to cut. And when you look at the real backdrop, there's $1.6 trillion of commercial real estate debt coming due in various maturities over the next few years across all asset classes. And I think there's a lot of sponsors who are mathematically underwater or in real trouble for their debt maturities. And the Fed cutting rates is not going to bail them out. The capital stack still needs to be reworked. Properties that were underwritten with no interest rate caps at peak valuations are going to move from weak hands to strong hands. And I think, what really is, I think, more interesting, I'm not a doom and gloom guy, but what does a 50 basis point, cut mean right off the bat? In general, if you look at financial history, when the Fed starts cutting, it's in the jaws of a recession. It's a harbinger of worse things to come. If you look at the unemployment numbers that have been revised over the past years, really there are about 1 million fewer jobs than we thought there was. I think that perhaps is the last situation we're going to see come into fore. But I think from an investor's perspective, this will be a multi-year story where there'll be opportunities of properties that are going to need to be restructured, need to be worked out, need to be valuation repriced, and that will be a lot of opportunity. I think for owners that got over their skis during the ZIRP era, where there was a lot of folks who were tourists in various asset classes, the Fed cut is not going to save them. And I'm skeptical that if in an era of where we had a lot of cheap money for many years, that we still haven't seen that fully work through the system, the consequence of it.
Thank you. Stephen, would you like to share your thoughts on the economic outlook?
Sure, I'd love to. Much of what has been said weaves its way through my conversation as well. The fact that we've got $1 trillion of maturing debt this year, $1 trillion next year, in a higher interest rate environment than we've historically seen, in the middle of a credit crunch is deeply problematic. And being on the front lines of the workout advisory group, we see the
It's okay.
sorry.
Keep on
We
going,
see the
Steve.
distress essentially everywhere. I've never seen a market. This will be my fourth downturn when we actually realize a recession, and I have not seen the real estate market so dislocated. As an example, a couple of weeks ago, I posted on Facebook that the average home price in the U.S. is reached an all-time high at the same time that we've seen transactions at a two-decade low. So there's a disconnect there that, frankly, from a demand supply perspective, makes very, very little sense. Lastly, I would say that in terms of calling a bottom or what the outlook looks like, I think we're a long way from the bottom. I still think we're frankly in the early innings, and I will support that logic by simply saying that until we see a significant level of distressed transactions in the market, forced selling in particular, we won't see a bottom. And that forced selling, as you know, as a result of the kick the can down the road policy, has not yet started to happen. Now we've started to see, and actually for the last 12 months, we've seen an increase in no transactions, which is sort of under the board. We don't see a lot of that publicly, but it's starting to happen. And I think that's just the beginning of the cycle of cycling through this distressed debt primarily. Because it's like, let's be honest, it's debt that's forcing the stress on a lot of owners and investors. So yeah, early on in the cycle, guys.
Actually, I'd like to jump off on that. And how do you anticipate banks are going to deal with the troubled real estate portfolios and workouts?
Will there be a bailout?
Aren't these mostly regional banks and not wirehouses?
No,
Can we
I think it's fat.
differentiate?
I'm sorry,
like
could
your-
you go ahead? How do I think banks are going to deal with the distress? Well, it's just like real estate, the actual hard asset. I think banks are, I forget it, the national money center banks, the B of A, the Chase, etc. I think from what I can tell, look, guys, and I don't have deep insight into their portfolios, but I will tell you that they have learned and retained the lessons from some of the past downturns, and their risk profile is far, far different than, say, a regional bank or a CLO type lender. I think they're well positioned, they're well secured, and they'll easily weather the losses they will take, of course, on the commercial real estate side. Look, nobody expected office buildings in 2019, which are effectively the blue chips of that asset class, to be valued at 80 to 90% lower today than they were just prior to COVID. So that's one. The bigger risk from my perspective, and we really won't know how this all turns out until we look in the rear view mirror, right? That's when we truly learn our lessons. But the regional banks, from my perspective, are a major risk profile in our economy. In working with a lot of regional banks and what we do, we've seen, and we can justify that there's very few banks that are fully reserved against potential commercial real estate losses. And when I say fully reserved, banks have to set aside, if there's a potential or probable loss on an asset, they're instructed through various guidances to set aside reserves for those potential losses. And in dealing with the banks on particular assets, I'm seeing that's frankly, guys, just not happening. They're kicking the can down the road, just like a lot of borrowers are today. So is it a problem? I think it is a problem. And I think it's a huge, huge issue. The Silicon, Signature Bank, First Republic banks, those were three of the four largest bank failures in the history of the US. My perspective and opinion is that's just, guys, the tip of the iceberg. There's a lot more to come down the road. One more thing. I've heard that some of the greater minds in this space have said we could see a regional bank fail on a weekly basis. And I think that might be 12 to 24. Barry Sternlicht of Starwood made that statement. I think that's a possibility 12 to 24 months down the road.
I mean, if I can add on to that, Stephen, there are more than 50 banks on FDIC list, which are so-called zombie banks. And
Right.
what size, what regional area, we don't have a privacy or privy to that. But the whole issue is the banks are all kicking the can forward. Nothing else. I mean, there is no trade. I mean, when you had 2% or basically 0% funding, and now you're looking at 7-8% cap rate coming into your commercial product. And on top of that, your occupancy is 50-60%. How do you justify it? To the extent the employees do not go back to work and office buildings do not have occupancy or a new use case, banks have no choice. No, I mean, you made a statement the banks have not really reserved. I would go as far as saying banks are just kicking the can and trying not to even mark to market their asset at current values, which we all saw back in 2007, 2008, how mark to market risk for CDOs and CLO drove most of the asset downward. We saw that. I mean, we were part of it. And but that's the risk. And there is no FASB ruling coming down the pike. There is no FDIC ruling coming down the pike from, or even any other regulators, even the Federal Reserve is letting all the banks kick the can basically forward on all these loans. And borrowers are desperate. I mean, there are properties we are trying to bid in and we are missing. I mean, these properties are getting sold at below reconstruction level. Sometimes they're getting sold at the land value level all over the nation.
Absolutely right. Yeah, absolutely right. Particularly in the office space, right?
Yeah.
There's some cities where you literally cannot give your office building away because it represents more of a liability than an asset. So
Yep.
100% on board with you, Rich.
So I'm actually also going to ask you about the office market, but I would like to close out with your thoughts on.
Yeah, I agree with a lot of what my fellow speakers are saying. I think, again, we've been conditioned during the past few cycles that we immediately think that a rate cut cycle all of a sudden means that there's an ease in the credit environment and a lending environment. And I think if you look at the state of the health of the banking system right now, particularly regional banks, where almost 75% of the commercial real estate loans are concentrated, there's a lot of zombie banks, and the credit spigot is not going to be turned on to help the borrowers, to help people with troubled properties. I think that's where, on the investment side, the opportunity really is in structured credit, alternative lenders, preferred equity, co-GP funds. And there will be, I think, the trigger for the distress cycle is the maturity wall. Regulators are not going to put up with what happened with Silicon Valley Bank and First Republic again, where they, really there was just very shoddy risk controls and very poor underwriting from an interest rate perspective. And they're going to say, okay, big banks, you have to restructure, you have to recap, whether it's the, with the bank in Texas that was just bought by a consortium of groups. New York Community Bank also had a restructuring. I think then they'll puke out their loan portfolios at real trading values. And that, I think, will be an ongoing story for the next few years.
What's your timing on that?
I think this is not going to be a flash in the pan. I think there'll be 3 to 5 years where these maturities get worked through because the interest rates will reset and the consolidation that will happen with weak banks having to right size their balance sheets. And I think the era of private credit and alternative lending strategies is going to continue because there's this gap in the marketplace for borrowers where the banks that have big loan loss reserves, they can't do new loans. So I think this will be an ongoing story that will not be, one tsunami, but it also won't be something that ends in next couple of years. It'll be more of a 3 to 5 year situation.
Absolutely.
Want to add anything, Chris?
No, I think that I would definitely agree with everybody here. I think it's definitely some potential for quite a bit of doom and gloom for sure. And let's be real, this is a cyclical industry. Rates, real estate, it's not like medical, it's not like health, and it's not like some of the consumer products out there. But at the end of the day, that's where the opportunities lie. We have investors here, and I think that's something to keep an eye on, but at the same time to keep an eye on their portfolios as well. That's really what I would suggest is look at your portfolios, look at your risk profile, and I'm always about de-risking personally, just having been through numerous cycles myself, and I would prefer to go through and play and vote on the side of caution and go through and move accordingly.
So that actually, I do have another question that's tied to that. With the rise of real estate debt, curious to know, what do you think that's going to look like in the next decade? So I actually worked in the past decade, I spent time raising capital for a private equity and a private credit firm. So I got to see the rise of sponsor-backed lending, direct lending, peer lending into equity. I'm curious to see how this translates into real estate and what that looks like for you all. Rich, do you want to start?
I would say you will see much more equity coming on the table. The days of just developer putting 2%, 3% equity, and then loading it up with mezz debt and preferred, and then loading up with the senior debt from the banks at maybe 55, 65% LTV. I think those days are numbered at this point for at least next cycle of interest rates. As far as more debt coming down the pike, mostly it's from private lenders right now. I mean, we are damn busy. I mean, we are doing mostly hard money lending on 1 to 4 or commercial and hotel motels. And I tell you, we are cherry picking deals, what we want to do and where we participate. Rates are definitely going to be here. Fed is, as I think one of the colleagues said earlier, started behind, and perhaps this cycle of cutting rates are also behind. But this 50 basis point definitely shook the market up a little bit. And we'll see how it pans out in the next week or two.
But I mean, a lot of the real estate policy has been caused by loose Fed policy, right? A lot of the distortions. I mean, there's some real distortions in real estate, right?
I mean, there's always a hesitation on regulatory, though. At the end of the day, there's too much politics.
Well,
I would beg to differ on this term of real
regulation.
estate. Marty, in the past, yes, I can agree with that. When the Fed left the rate almost 0% for more than a decade plus. Not this cycle. This cycle we are seeing. This
Agreed.
cycle we are only seeing because the rate had to go up in 15 months. I mean, rate went from 0 to 5.5, 5.25, 5.5 Fed fund rate, and everything went with it. So that's the destruction we are seeing right now. Inflation had to be reduced, and Fed did what they had to do.
Do you guys see rates going much lower again?
Definitely see rates coming down substantially, but I think that you also, in addition to that, with that is going to be, you're going to see home prices come down as well. And you're going to see also the real estate community, commercial real estate outside of your storage facilities, hotels, condo hotels, whatnot. And there's a reason that they're cherry picking those. Those are less risky. When you look at the commercial real estate, I mean, San Francisco is a unique beast in that we are specifically a tech-focused commercial real estate industry. And I think that that's going to be hit the heaviest and the hardest. It already has been. As we're seeing properties, as you mentioned, can't give them away. Great opportunity. I've discussed it with my wife, buying one of the buildings and making that our new house. And we're buying like a 10-story building. And we got a 2.5-year-old daughter. She can have a whole floor to herself.
345
California.
Oh yeah.
Office building.
Yeah.
You might have a place for all the shoes.
It's cheaper than buying. And when you look at it, I mean, let's be real. It's cheaper than buying a house. And I'm getting much more real estate. Hell, I got a
By square
concierge
foot, it
downstairs.
absolutely is
I got
cheaper.
parking. I can do a park. All right, I'm going all the parking
Incredible,
I ever wanted.
actually.
I'm getting
Thinking
off topic.
about it.
Yeah, we're having fun here, but getting off topic. But at the same time, I'm looking at logic-based approach to this. People are not in tech going to come back to the office. It doesn't. The costs associated with running an office is substantial. To have that concierge, to have the insurance, to have security, to have cleaning. I mean, how many times do you guys leave on the damn? I mean, I live over there and I can see all the lights on. I don't turn off the damn lights. I mean,
That's so
there's
planes
a-
won't crash.
There's maybe not the ones on the top.
How long do you think that there'll be a bank pullback for? How long do you think it will last? Until the restructuring's over, or?
I think that again, cycles typically we're looking at, we're going to be seeing, are we going to see the bottom immediately? Is it going to be a fall? No, I think it's going to be over time, and there's going to be a trough. I mean, it's no different than 2008. It wasn't until we saw October of 2012 was the bottom. On October 2012, that was the best month to buy.
I think you said, it goes
100%.
back to what's that law of physics for every action, there's an equal and opposite reaction. I tell this to my 8-year-old children. You can't escape the laws of physics and math and economics. And we had a big party for a long time, and
Right.
there's gonna be a hangover.
Yeah,
And
party's
I think,
over.
and I think, we need to be honest about that, as an industry as well as maybe a society too. And, the excess that needs to be worked out from, misallocation of capital that happened during the ZERP era from bad sponsors who were over their skis in terms of their capital structure. That's
Yeah.
where the opportunity is going to be. And it's the same on the banks and the lending side. Banks were profligate, they were imprudent with their risk taking, and there are going to be a lot of bank failures. And that will be a contracted credit environment, but there's a lot of opportunity for alternative investors to fill that gap and get really what I see as the opportunity is the asymmetric risk profile. You can get debt-like security with equity-like returns, and that's a great place to play in for the next few years.
Absolutely.
I mean, I can play this scenario out on this transaction for a while. Is assume that Fed cuts all more rates down and the Fed fund rates come to 3%. Most of the commercial buildings will still not be able to restructure themselves. That's the reality of the market we're seeing. An earlier comment to Marty, how long it will take? I mean, our expectation is that this decade pretty much will take to solve all this out. 3-4 years at the minimum, but the tail end you will see correction coming through at least a decade. If not longer.
If we look at the general cause of our economy for the last 4 years, effectively, it is Federal Reserve policy.
Yep.
Federal Reserve, in their astute wisdom, injected $17 trillion into our economy in 2020, almost exclusively 2020, which is an increase in M1, the primary money supply, by 550%. This is an experiment that has never occurred before in the history of the US. And as a result of all that excess liquidity, which still, by the way, exists to a very large degree, which is why we're not yet in a recession, but it's the result of that excessive injection of liquidity and zero interest rate policy that caused effectively the bubble of everything economy that we're in today. We're still in it, guys. Home prices have not retraced at all. And more than likely, given that run up, we're going to see something like a 40% retracement in pricing. And that's not true just for single family homes. Pick any asset class, whether it's the equities market, whether it's used autos, single family homes, there's a retraction or retracement that's inevitable. And it's inevitable simply because of misguided Federal Reserve policy. Now, we know the Federal Reserve tends to overreact. Their radical increases in interest rates has had a devastating effect on commercial real estate. We know on average, the asset values have declined about 25%. And we're not even in a recession yet today. Will they react and react aggressively? Of course they will. They have got a history, particularly this regime, of massively overreacting and generally too late. Look, it's all that injection of liquidity that caused the very inflation that they're trying to crush with the sledgehammer. Now they're starting to retrace on that and pull back that aggressive interest rate quality, call it QT. They're starting to retrace on that, but it's still going to be painful. And until that excess liquidity in our marketplace is effectively gone, we're still going to be living sort of well above our means, if you will.
What if the United States goes in the direction of like Japan and decides to go with, 50-year and 100-year mortgages?
I mean, I don't think that that's the right move. We're already seeing, so getting into these creative loan types, in my opinion, I call them creative because in the day, you look at 40, 50-year loans, that's what got us into 2008 problems, the interest-only loans, the prepayment penalties. Right now, we have DSCR loans. Talk about a big landmine right there. And our company, that's what we do, is we automate underwriting and processing. We see it almost exclusively DSCR loans, non-QM loans coming through. And how many of those, and again, it's all private information, but I can tell you that just talking to people in the industry and being on so many of the forums that are public information, if you're in the industry, we have people who are qualifying for DSCR loans when that's their primary residence. Obviously, they're not renting these out. They're not getting rental income.
Is the DSCR getting done with a minimum down payment, or what's the down payment requirement?
It depends on the lender at the end of the day and their overlays, but really that's not the problem that I'm trying to address. I'm trying to address that there are now loans, especially when the rates got high. Lenders, banks, brokers, credit unions all had to get creative. They started redoing We started seeing interest-only product coming back.
Mm.
We saw prepayment penalties.
Yeah, that's
Now
all
you
trouble. I
saw
mean, if
40-year,
we-
50-year loans coming back. They're trying to go through and qualify people that just don't qualify. Why can you qualify for a $100,000, few $100,000, $1 million property and you can't qualify for a credit card? That just doesn't make logical sense.
yeah.
Yeah,
Doesn't-
questions from the audience that I'd like to address. Paul, did you?
Yeah, I just wanted to ask, and focusing on the banking sector and positing that Silicon Valley and First Republic were merely harbingers of the future. And one other factoid, my professor at Stanford, banking professor, used to say, America, where everyone can own a gun or a bank. And I say that because we have 7,000 banks of all sizes in this country, 350 million people. That's one for every 50,000 people. Canada, nobody's idea of a spectacular economy, but theirs is 1.5 million people per bank. Are we tending in that direction and will be salutary for your businesses?
I'm a capitalist. I believe in free markets. I think, it's never necessarily a good thing when you have a winnowing of the lending sector and an attrition, except for the fact when you have weak players removed who did imprudent things. I think that the concentration risk of too big to fail in the banking sector is real for the money center banks that are really playing at a higher level than their regional and particularly their community bank peers. And I think you're seeing that with the stepped up regulatory standards for, what the loan loss provisions have to be, what the market capitalizations for certain kind of scrutiny of banks by regulators. And the concern is that if you have so much consolidation, you have anti-competitive practices for the consumers and for the borrowers. I don't think we're anywhere near that. There could be a lot of healthy consolidation. And I think there could be a golden age for alternative lenders and alternative investing strategies that fill that gap, that are perhaps more unregulated and more creative in their solutions. And that, I think perhaps is how that unfolds in the next few years.
Thank you.
I tell you, I second that. And there will be consolidation. Maybe the total number of banks will get reduced to 3,500, 4,500. And still the regional banks play an amazing role in our diversified economy as a whole. They know the localities, they know the local players, who's better than them to provide their services. The notion that we can consolidate into maybe 10 or 15 top banks, that's too big to fail. And we have seen that movie played out a few times. And I don't think as a nation we can tolerate that. And I don't expect that happening.
I mean, there's still gonna be some level of that to kind of ride along it, but also provide a little more clarity. At the end of the day, you do have your larger banks, and they are the 800-pound gorillas, or as I like to call them, they're the bullies at the poker table. So they definitely can bully. They have the opportunities to go through and do that, but then in order to go through and to play, you're going to have to go through and have niche products, and that's where these regional banks, as we're talking of them, they are filling niches because that is how they are getting their business. That's how they're growing, and they're stealing market share away by doing these, but they are higher risk. They have to do higher risk loans in order to go through and compete and differentiate. Differentiation is, at the end of the day, how we go through, and that's how you invest in startups and tech, everything. I mean, we have to approach banks the same way. And I think that at the end of the day, that is where investments in maybe technology is going to be kind of an intriguing factor too.
It's really interesting. If you look at what's gone on thus far in this semi-cycle, we're seeing the big banks gobble up these regional banks and do so at a huge profit, massive margins. We have to expect that same thing is going to continue going forward as some of these smaller regional banks fail or are on the brink of failure. And they'll call JP Morgan and say, hey, what do you think? What do you want to do here? And they'll write the check, and they'll write the check quickly, and we'll make a fortune doing it. On the other hand, your point is extremely well taken that regional banks are a critical part of our community. Their lending, their involvement in the community creates more vibrancy in that community. And that liquidity is important from everybody's perspective, as either as a consumer or a business owner. So your point's very, very good. Thank you.
Yeah, I mean, I don't think there was a soul here in in the Bay Area that didn't feel the impact of Silicon Valley and First Republic closing deeply.
Wow.
It impacted all of our businesses, and we were all scrambling to get either bank accounts or our own liquidity. And, that took several months. So it'll be interesting to see. There was one more question or two more questions in the back. Yes.
Right, I just want to make a comment. I just kind of put two and two together as you folks were talking, then I'll get to my question. It seems like these regional banks can't win. So I live in Chicago, but I grew up in Boston, so I know the banking industry better there. Okay, so we have a bunch of regional banks that know their markets, as you say, but that means by default, all their loans are going to be in that market. So if there's a natural disaster like happened in Maui, or an economic problem that's maybe a regional problem, if it was a Texas bank and oil and everything, it's like they can't win because by default, they're gonna be in their, what?
Can you clarify?
Surviving.
Survive? I think that they can survive. I think it's no different than, again, I liken this to startups because that's what we're doing right now with RealKey as a startup, right? At the end of the day, there are bigger players that are more capitalized that can go through and maybe they're not differentiating the same way. Same time, they can win by going through it. Maybe that is part of the goal is to get acquired, to get consolidated.
Well, yeah, if you want to get
join
acquired, that's
somebody
different.
or become a subsidiary of. I really do wish that when First Republic became part of JP Morgan, I do wish they had kept the brand because that was a unique role they filled. And there is nobody like First Republic and the service that they provided, taking away the risk side. They really knew how to do customer service better than absolutely anybody out there.
Yes.
All right, so my question though, if our current vice president wins and if her $25,000 free money to buy a house goes through, I mean, what's that all about? How would that play out?
That might be a better question for other people on the panel, but just, I think that the larger backdrop is, we can't suspend the laws of supply and demand. If we want to solve housing affordability, we got to allow massive upzoning. We got to allow the decrease of red tape for new development. That's the easiest solution. Anything that's done on the supply side is going to dramatically outweigh what's done on the demand side. And by stimulating demand, which, not a political comment outside of that, it's, not partisan political, at least, whoever gets into office has all sorts of ideas for subsidizing demand. And really, they should be focused on working on the supply side of the equation, in my opinion.
Can I just make a comment on your supply side comment? I know John Williams, who built Buckhead in Atlanta, right? And he said, he spoke with one of our friends 10 years ago, and he said, when I started in the business, there was 8,000 licensed home builders in Atlanta, and now there's less than 800, right? Because of the regulatory state, right? One of the things that you brought up, which I thought I wanted to add to, is that all these cities that have now average housing prices $1 million, like Miami, the median household income in Miami is $62,000 a year. So how can people who bought houses 30 years ago and were like mechanics, their houses are worth $800,000 now, right?
$25,000 to answer your question is not going to do anything because you still have to look at, can that person with the $25,000, great, that's part of the down payment. Can they even afford the mortgage? Can they qualify? Is their credit ruined because they can't afford anything and they've had to go through and go into debt because of it? I think that you're still looking at, when it comes to these regulations, and this is where politics gets in the way of logic all the time, is that you're going to be looking at, you have to put the money in the right hands. And that's a very small subset of individuals. Is somebody who is low income enough that really needs it, but that also can qualify for that house at that price, at that rate.
No set.
I mean,
Or maybe
if I can add on to Julian's comment, the issue still is.
Rich?
Can I go ahead?
Yes.
So I wanted to add on to Julian's comment. The issue still is we're not building as many homes prior to COVID level. Why the hell we are not supplying more homes and more resources in building the homes or building the apartments is that the regulations are killing most of the builders. And to your comment, Marty, between 8,000 builders to 800 builders, that's reality. I mean, most of them get wiped out during 2008. And then we have put up much more restrictive environment post even COVID. And we are still not pre-COVID construction level. till we improve that, any amount of dollar you can throw, you're basically creating more demand, and you will have more demand and supply in equilibrium, and then you will have challenges.
My comment was on the diversion of price versus income in many of these cities.
Well, that is the most important component of this, right? The
Yeah.
reason why pricing of homes went through the roof, it was not that people thought that's a good price to pay for the home, but it's what they could afford on a monthly basis because we were living in a zero interest rate policy situation. When interest rates went through the roof, demand fell through the floor, right? And we see that, and that's that juxtaposition I talked about earlier. How do we just hit an all-time high on prices, yet see an all-time low in transactions, right? It doesn't correlate. That's a breakdown of supply and demand, but fundamentally the issue is this. The cost of a home is far too high today. It should never have been that bubble in home pricing should never have occurred, but it was primarily driven by federal policy, whether it's the influx of liquidity or zero interest rate policy for an extended period of time. And that is something that will have to be resolved. We go through these downturns because they're a natural occurrence, and we will have to see some pain, and that pain will be fairly broad because we're still living in the bubble of everything type of economy. But somebody mentioned doom and gloom earlier. Guys, this is also an opportunity. We talk about raising capital. It's been very difficult for the last 2 years unless you're raising capital for a distress fund, which is a totally different animal.
Oh, no, you got about 10 minutes? Yeah.
Okay, we have one more question I want to get to. Yes.
Is there an argument to be made that today's rate cuts would actually support another leg up in real estate prices? And I guess every asset class is nuanced with, debt maturities and whatnot, and vacancy in office and all that. But is there maybe a contrarian case that real estate continues its ride up?
I'd love to hear the contrarian case because I think as an investor, you always have to stress test your assumptions, and you never want to be, in an echo chamber of your own thinking. I think there's a disconnect between this notion that the minute that rate cuts happen, all of a sudden the credit environment improves from the ease of the lending environment. And, his financial history would show you that's not the case. It can happen later on when credit conditions improve, but after you go through a recessionary cycle to deal with the excesses of the bad loans from a prior time. So to one of my earlier colleagues' point, which echoed one of my earlier statements, if you're sitting on badly underwritten real estate that was bought at too high a price with interest rates that were on debt that was much lower priced with no interest rate caps, when a maturity comes due, it doesn't matter if the Fed cut 50 basis points or 200 basis points. If the valuations are down 30, 40%, the math doesn't work. And that real estate needs to be repriced. The capital stack needs to be reshuffled, and new investors need to come in and trade it at new values. And I just don't see the bull case for another leg up.
It could just be a window to actually dump bad assets.
That's exactly what we're gonna see. Is we're gonna see a slight bump. I think there's gonna be a hesitation there. Is that you're gonna see the rates just came down. You're gonna see an increase in loan applications. Fannie, Freddie, everybody's gonna announce this, as well as all the lenders, banks, brokers. And at the end of the day, those are refinances. And if you see any purchases and people are moving, those are again those that have plenty of capital to go through and to throw at going to a new property, even increasing the size of their properties. But what you need is that you need new home buyers to be entering the market, because all you're doing is, again, you're kicking the can, and this inevitable correction that we have all been talking about is going to happen unless we see new home buyers entering the market. And we just don't see that. It just doesn't make logical sense. There's a lot of illogical reasons that people are doing loans for forever. And that's usually there's a lot of times when people are getting mortgages when they really should not be getting mortgages, buying houses when they shouldn't be buying houses. I have a kid, I have that. It's this notion of the American dream that is kind of built into all of us.
But it's not just single family homes and the whole thing about payments. It's these syndicates that were formed, a lot of them out of Texas and Florida, that were just guys were like saying, great, I'll put 100K in and we'll get 50, 100 investors. We'll buy $10,000 of real estate, use leverage, make it 30,000, and then when the rates went up, nobody was a significant enough, capital person to be able to bail them out when somebody had to pony up more money because there was a change in the, equations of leverage, right?
I think that,
Yeah.
on the rest, that is
One of
the. But, sorry, go
One of the
ahead.
biggest
Steve?
challenges that we're facing today is that we're still looking at negative leverage. Cap rates should be, there's an inverse relationship between cap rates and interest rates. Until that inverse relationship corrects itself, we're not going to see a massive increase. Now that 50 basis point decrease in costs of capital will have a beneficial, there'll be a pop as a result of that. But transactions are way off the cliff. They're way down from where they were in, as an example, 22, which was an all-time high. But that inverted relationship, when your cost of capital is higher than your cap rate, it just doesn't work, which is why transactions have been so slow, depending on the asset class, of course, until that inversion occurs. And that inversion is going to happen through distressed asset selling. Cap rates will get pushed up when assets are forced to trade. Until that happens, 50 basis cuts not going to do much, in my opinion.
No, it's not. But I can see that in incremental buyer appetite for single family homes.
Sure.
It may not see much on distressed debt of commercial or massive office towers, but I can see incremental buyer being able to qualify with a 50 basis point reduction instead of a 6.5, 7 handle mortgage, 30-year. You may see 6, 6.25, and some people incrementally may be able to qualify.
We have a question from the audience. Sherry?
Yeah, hi. This is a question for Stephen, but really for everyone. We know there's going to be a rebalancing, a repricing. That's the sine wave that we live through over and over again. Looking in your crystal ball, what do you think would be a realistic time frame? It's particularly for residential.
Yeah, so my crystal ball's not particularly clear. It's a bit fuzzy. I think we all expected the recession to hit more than 12 months ago. It hasn't, again, because of that excess liquidity, guys. But in terms of residential, it was mentioned earlier by one of the fellow panelists that in the typical cycle, peak to trough, that is about a 5 to 7 year period. So when will we start to see values decline? Well, it should start happening today. In fact, they are starting to happen, depending on the region you're located. I wouldn't expect to see a bottom until, I don't know, pick a day, but it's not going to be earlier, in my opinion, than 26 or 27, and it could get pushed out. In the meantime, though, there'll be one-off opportunities to acquire at deeply distressed pricing. And that's the nature of the game, which is why there's $300 billion in debt set aside ready to jump when this pot starts to boil over, if you will.
Yeah, no doubt.
So I think that distressed debt is local, just like most real estate. But I just want to say that, so I grew up in Miami. In 1963, there had been amazing time of prices just skyrocketing, and a hurricane hit and chased away all the Northerners who had bought speculative land or apartments on Collins Avenue, et cetera. That pricing on Collins Avenue did not increase again until 1987.
We just need an earthquake here.
So I'm just saying, people buy houses that, for $70,000 or apartments for $70,000 in 63, and they couldn't sell them for more than $70,000 until 87. That's a pretty long hold time.
Yeah, it is.
Yeah,
You
no,
may
I mean,
not part of the business plan.
if I can order on the single family home side, here's the two issues which are happening within the single family or condo environment. Majority of the folks have their mortgages done few years ago. So they had 2 handle or 3 handle mortgages, and they're not going anywhere. So your supply is very much restricted. Demand side of that is still huge. People want a new generation wants to come in and buy, and the prices keeps going up. And the people who have financed or bought a new property, they bought at a higher rates between 21 to 22 to 23, and they are well set to refinance. So you'll see much more refinance activity, but till the supply of the homes improves, I don't see the price reduction in the single family home environment. And I don't see any major distress in a single family or condos because majority of the folks have their mortgages at 2 to 3%. If we have a massive recession, that's a different story.
There's a lot of coastal issues on multifamily, Rich, with insurance and HOAs, where pricing is going through the roof. I mean, that's a secondary issue.
That's correct. I mean, in multifamilies, the issues are, depends where you are. If you are in a rent control environment and your occupancy is limited, then you have challenges. Otherwise, if you're not in Florida, a 30-year prior buildings were made for you. You don't have to worry about new laws of refixing and retrofitting for building to collapse and whatnot, then you're okay. It all depends. I mean, real estate is always local, right? So you have to pay attention to where you're looking at.
Rich, I don't think it's just Florida. I think it's coastal United States. Looking at these 30-year-old buildings. It's not just Florida.
Florida is the one who passed the law. Other states have not, or some states had already passed the retrofit laws, which are already in place.
It's an insurance, but
I think the insurance market, is another story.
That's another one, yes.
The insurers for many years were not getting compensated in a low rate environment for
Yes.
their own investment portfolios to justify the amount of 100-year weather events that were happening every couple of years.
Right.
And now when you see the retrenchment of insurers leaving markets completely in California, whether it's for fires or whether it's for various other issues, even insurers just leaving the market. That's driving up prices. The same is true for the Gulf Coast and the coastal Atlantic. That's a real problem, and that's messing up a lot of people's underwriting. And for people who are owners that are teetering, who already have challenges in their capital stack and their deck, they don't need 100% increase in their operating expenses. That might also be another catalyst that pushes properties from weak hands to strong hands.
Yeah.
yeah, I mean, somebody I was talking to said, my HOA's gone from 200 to 800 in the last year, right after COVID happened.
Right.
And they were on fixed income.
Yeah, that's challenging. I mean, not only that, how about your insurance goes from 5,000 to 65,000 and you live in Malibu? Or in our area in LA or outside LA area, same thing going on all across the board. I mean, our insurance went up almost 300%. What do you do? I mean, if you can't qualify, then you have challenges.
This is another area that we're going to see some potential consolidation. So as an example, those with blanket policies where they're able to spread the risk for their insurer over a variety of assets in a variety of locations are going to end up with a far better rate. And so that could drive consolidation. I'm not saying it's going to, but in my experience over the last 6 months, we've seen some significant consolidation, at least on the property management side. And it could easily translate to something much bigger than that. Because insurance is, I mean, that's up, what, 300% on average over the last 2 years in the state of Florida, at least.
If you can get it. There's some
If you
properties
can
you
get
can't
it.
even get insurance on.
It's insane. I think this is still getting into risk, and you're still getting into individuals that were qualifying for loans even when they were as low as they were, and they were just qualifying for the maximum amount. Imagine, yes, like you said, your insurance all of a sudden spikes. You also have your HOA spike. You have
It's all at once.
It's all at
Utilities are
once. You
spiking.
have all of you have the inflation on top of that, and you don't really have a way out. Your income is not increased if you're fixed, or even if you're not fixed. It's going to be people getting, as we said earlier, it's going to be people are going to get forced out, and that's something that's going to happen. That's going to affect the banks, and I think supply definitely is a big factor here, and it might be helping out with the supply. Because I don't see regulatory moving fast enough. Never have, never will. There's too much politics involved. And there's also too much lobbying going on from those that do have the properties and the portfolios that want to protect the value of them.
Wait, can we have some closing comments? We have about 2 or 3 minutes left. Rich?
I can go. I mean, closing comment would be this is a great opportunity if you are in distress environment and you look for distressed properties carefully, look at the data points and look at the value propositions, what's going on. If you're looking for a single family home, just redo your HOAs and make sure you're looking at insurance cost before you're buying it. And if you're a lender like we are, it's a great opportunity.
By the way, I think Florida just passed an HOA law for transparency.
I'm sorry, could you repeat, please?
Florida just passed an HOA law forcing more transparency out of HOAs.
Yeah.
Brilliant.
I mean, that was the law I was referring to. Also, they also improved that any properties which were built 30 years prior, they have to be retrofitted.
That's
And
one
all
thing,
the
yes.
HOAs were hiding, and this was the major thing within the HOA when that building collapsed.
Yes, Steve?
Yep. Closing comment. Well, we've talked about doom and gloom, and we all have sort of a negative slant towards the outlook of real estate, but we look at it as a potential once in a generation opportunity to acquire assets at deep discounts to their intrinsic value and certainly replacement value. Word of caution, early is the same as wrong, and we see that time and time again. I was asked recently how to hedge in this environment. The single way to both hedge and protect against single way to hedge today is to buy extremely well. And to me, that means the asset is encumbered with a multiple list of challenges, whether it's an occupancy issue or an over leveraged issue. Finding value today, not terribly challenging, but finding the right value at the right time, that's the opportunity and the challenge both.
That's my quote of the day. Early is the same as wrong.
Thank you, Marty.
I concur with many of my panelists. As someone who's seen a few recessionary cycles and was partnered with Lehman Brothers on a fund during the financial crisis, this is the best buying opportunity I've seen for real estate since that period. And I think it'll be iterative. I think it'll be over multiple years. And it's back to being a good value investor. It's back to being a margin of safety and getting paid for the illiquidity and the risk you're taking. And it goes back to that asymmetric risk return trade-off. If you can buy fundamentally sound assets for a deep discount to their intrinsic value and earn a real rate of return for that, there's going to be a lot of opportunity to do that over the next few years. And alternative asset managers and allocators are under allocated to real estate as an asset class. And that's a real opportunity to make sure you're getting that kind of return in your portfolio.
Yeah.
Amen.
Agreed. I think there's been some great sound bites. Definitely concur that moving early is the same as moving wrong. I think that there is definitely an opportunity, though, if you are to move early and you do already have a portfolio, to go through and to take advantage of the market where we're at today, so that you have the capital to go through and take advantage of the market when the timing is closer to being perfect. Obviously, we don't have a crystal ball, but there's a better time to buy and a better time to sell than any other time. I think at the same time, it's looking at where your other opportunities, obviously you need to put that money elsewhere. I think there are big opportunities. If you look at some of the spaces that have been starved of capital, finance, auto, solar, all these places, you look at technology in general, there hasn't been a whole lot of investment in those areas. And there are definitely opportunities that are there as well. These are companies, construction tech, reg tech, and these are things that are going to solve the supply problem. You're going to have property management, bringing down all of the costs, increasing the supply. That's an opportunity. If you see any technologies in those spaces, that's where I see go through and to move your portfolios and your capital elsewhere.
Do you want to make a last comment since you're actually working in a sizable fund in the distressed space?
Yeah, I mean, so we're seeing a lot of opportunities in the build to rent space. And so we've been pretty focused on that. I'm pretty excited about it. For example, the model of an individual that would like to build to rent. I personally would not want to buy a mortgage. I travel a lot for a living. I am, single. I don't want to deal with a broken water heater when I'm in Chicago on a fundraising trip. So I'm absolutely your perfect tenant. So I encourage the build to rent model. And we're seeing a lot of opportunities. I'm getting questions about retail, which is very interesting to me. And office continues to be absolutely top of mind because we have a lot of, product to work out, but there's still a lot of buying opportunities in key locations. So we're actually excited, Argosy.
Great job. Well, thank you so much.